All right, welcome everybody to the Option Hour. My name is Don Kaufman. I will be the host of the Option Hour today, filling in here for Victor Jones, but I'm excited about it. I mean, hey, I get to fill in for Victor Jones on a day that the S&Ps are right now down 22.25. So as you guys know, I haven't done this in a while. I haven't done the TFNN show in quite a while, but last minute I came in as the kind of the pinch hitter here. So anyway, you're stuck with me for the entire Option Hour. With that, as you guys know, it's call-in show. Give me a call at 877-927-6648. And fire away any stocks, any options, any futures, any currency-related questions. You've got them. And take a look. Let's take a quick look at markets on the day. We'll do a little market overview. We'll take a couple of calls. I'll kind of discuss a couple aspects that I have seen in the market as of lately, and some selling into today, which I've ultimately believed has been long overdue. It's kind of nice coming on here just periodically, and hey, I don't hesitate to say I've been a little bearish here for the last 3 weeks. What's funny is I got bearish in my mind at 1343. Ironically, we are at 1343 right now in the S&P futures, down 2150 in the day. NASDAQ futures down 3325. Dow futures down 185 in the day. It's the first real down day we have seen in 2012. And you got oil. Oh, sorry, oil's down to $1.93. Then why do they keep raising the gas prices here on a daily basis? And the VIX today up. What do we got the VIX up? 269, which, to bring that into some degree and some perspective, so you get the VIX up, people are like, it's $2.69. Excuse me, that is the S&P 500 volatility index. Respect it for what it is. What is it? Well, it's telling you that risk in the marketplace is 15% greater than it was yesterday. So let's see if the selling continues today. We haven't been able to stage a real sell-off here. Again, for those of you that have listened to me in the past, I grew up as a bear. I grew up in a bearish family. It's tough to grow up in a family of bears, but ultimately, taking a look at the VIX, up today, it's kind of an exciting thing for me. Like I like to see the VIX up 15%. Yet, I can't get excited when the VIX is at 2075 just yet. Call me when it cracks over 30 and people really start to wet themselves, because that's when it gets considerably more exciting. Anyway, the other thing that I always have tendency to look at is bonds. Bonds right now, /ZB and /ZN. Well, that's what seems to be what the symbol is on the ThinkorSwim application anyway. Those bond futures are pretty indicative of risk in the marketplace and fear. And you typically see, for instance, in days S&P 500 is lower, you have reason to believe that there's risk in the marketplace, correct? So what you look for in a day where S&Ps are lower, like today, you've got S&Ps now down 22, you look for bond confirmation and volatility confirmation. Well, we're getting both of those right now. We see the bonds up, and we see the VIX up. But, the reality that we live in here is that I'm not sure the bonds are going to go much higher from where they are. The /ZB, those 30 years, I mean, really, if you look back, and I'm not much of a market technician, but the highest that we've seen them as of lately is about 147. I mean, what I'm saying is that as bonds rally up, interest rates ultimately go down. Again, this product, these bonds, and I'm referring to, U.S. Treasuries, these bonds are utilized by traders, in essence, very similar to a hedge. I mean, that's what we're doing, is you're taking money and it's cyclically coming out of the S&P 500, for example, into the bond market, which, again, you're seeing a little bit today. It's a completely normal cyclical rotation. Let's see if the VIX picks up a little more steam and if some selling pressure persists in the market. Anyway, with that, I want to take callers. I want to take a lot of callers. So feel free to give us a call. It is a call-in show. That's what the Option Hour is all about. And, hey, don't hold back. I'll take pretty much any question you guys got. Good, bad, indifferent. I don't care whether you're bullish, whether you're bearish. If you think this is a buying opportunity, We'd love to hear from you. Not that I'm on the other side of that. Anyway, 877-927-6648. I'm going to jump to one of the first callers. It looks like we got Mike in Tampa. All right. So, Mike in Tampa, are you there?
Yes, I am. How are you doing this beautiful day?
Good. You have no idea how nice it is. I live in Scottsdale, Arizona. It's beautiful out here.
Oh, it's beautiful in Tampa.
Yeah, good deal. I'm coming down to Tampa. Yeah, I'll be in Tampa with Tom Sosnoff and Joe Mazzola in about 2 weeks. I think it's the 21st. We're coming out there for TD Ameritrade. So what do you have for us?
Well, covering calls on higher dividend paying stocks like NMM.
All right. So
not seeing anything there. Very little money in the options.
Right. So you're looking right now, and you know what? We could really, I typed in the wrong symbol over here, NMM. I've got it. So we could look at a variety of higher dividend-paying underlyings right now, and I'm not sure. I could utilize your symbol for an example over here, but wow, this is a really high dividend-paying underlying. Huh. First couple things I'll point out is that traders right now are chasing returns. Traders are always chasing returns, but many traders over the last few years have been shocked by some of the market downturns. August hit a lot of people fairly hard out there. So it's been, obviously, to say the least, a fairly rough marketplace, which has driven a tremendous number of traders into dividend-paying underlyings. I mean, one thing that, always comes to mind is ultimately some of the drug stocks out there, like the Eli Lillys, the Pfizers. We're seeing a pretty heavy dividend, obviously, in McDonald's as well. And these dividend-paying underlyings have been driven up considerably. Now, again, you haven't picked, with this Maritime Partners over here, this isn't exactly, one of the higher flyers. It's got relatively low volume on it as well. But there isn't really any option premium to sell additionally on here. I fear that, a lot of these dividend-paying underlyings could see some fairly nasty selling pressure in months to come. And again, I think that these dividend-paying underlyings are being utilized in lieu of the Treasury market. I think these dividend-paying underlyings, I was mentioning that it's been some rough times for traders and portfolio managers. So rather than go out and just dump capital into bonds, because the world kind of agrees that bonds are overdone. That's it's a very crowded trade at this point to say, all right, hey, bonds, we know that bonds have been bought to the moon. Interest rates are absolutely rock bottom. So traders now have gone out and they're buying up all these dividend-paying stocks. Why tie my money up in U.S. Treasuries for the next 30 years to yield a whopping 3% when Mickey D's over there is going to do better than that? And it's a key point to think about in regards to some of these dividend-paying underlyings, as again you could see a rotation out of bond markets and eventually out of these dividend-paying underlyings, and into again other aspects similar to the S&P 500. So it's just consideration over here in regards to your specific underlying, Mike. It's there's not a lot of premium to sell here. I wish I could tell you otherwise. It's just and that doesn't even have to do necessarily with anything other than liquidity here. There's not much open interest on this. Right. So I wish I could tell you, hey, you could sell a lot of premium in here. You could try to sell the 1750s. You might get them off. The market's 5 cents by 25 cents. You might get them off at 15 cents, but it's going to be a tough trade.
Right.
Yeah.
I'm just looking at, this is not just one, but if you look at the universe of them, they're just about all the same.
Right. And the premium that you're getting in regards to the options is simply from respect that implied volatilities, and I'll pull up like Lilly right now. The implied volatilities are absolutely rock bottom. If you take a look, I'll make a kind of an interesting point over here. I don't know if you're on the screen show. We're projecting a screen show right now, but
sure.
on Eli Lilly, you've got 15.5% implied volatility. Okay, that makes to me. I mean, granted, it's got a decent dividend. I picked Eli Lilly because it got a 5% dividend on here. Granted, there's the world jumps into this because it's got a decent dividend associated with it. But this scares the hell out of me because they're portraying Lilly as having significantly less risk right now than the S&P 500. And, I'm not buying into that notion right now that there's less risk in an individual equity than the S&P 500. I never have. And I don't like it. I mean, if you want to own this thing long term, you want to hold it because you believe that the underlying appreciates, great. But it makes me nervous to try to hold this underlying just to yield that 5% dividend. I mean, that being said, it is better than the it is better than the 30-year bonds right now, right?
Yeah. And it's more risk. I think more risk in the bonds, I believe.
Yeah. No, I mean, hey, the bond market right now, what people are going to get a rude awakening is I mentioned holding something for 30 years to achieve 3% a year. People are going to find out in a fast way that they're going to have to hold the bonds for 30 years to get their principal back, and we haven't seen that in recent times. And anybody that's been in the business for a long time, it says, oh yeah, you have to wait and literally let the bond completely mature to get your principal back. But you could see bonds really collapse at some point. And I've been preaching this for like 18, 19 months. Oh, bonds are going to sell off. Bonds are going to sell off. It could be the trade of the decade. Well, guess what? Now it's only the trade of the next 9 years because we lost a year in that. But sooner or later, I think that the Fed backs away a little bit and loses, I should say. I shouldn't say the Fed is backing away, but the Fed ultimately at some point loses control of the longer-term interest rates to ultimately traders, because that's where the vast majority of the capital in those treasury markets is coming from as traders. So anyway, Mike, it's good to hear from you. By the way, again, if you're in the Tampa area.
Would your opinion be the same of the MLPs? Gas
I'm sorry,
oil?
what are you looking at?
Would your opinion be the same on the MLPs, gas and oil?
Well, there's a whole different set of circumstances over there. That's a whole different set of circumstances because you've got, all kinds of geopolitical risk as well. So, I mean, natural gas has been a big hot spot as of lately. But like oil, I'm tentative myself in some of the, and specifically oil itself, the commodity, but I'm also tentative in some of the drillers and so forth. We've got a lot of clients that I talk to on a day-to-day basis that own just a ton of different, oil, different, some of the commodity itself. And my reason for that is, oil's volatility has been fairly extreme as of late. The question is, do you go into specific equities or do you try to get your position done in one of the ETFs, the sector ETF, something like the XLE, and that's going to be a little bit of a, again, kind of your own decision. Again, I'm hesitant in a couple of the commodity products right now, and it's more than just geopolitical risk. You've also got risk in the dollar itself. So that's, again, it's a tough trade out there right now. Again, my belief is I'm a big premium seller. I'm not seeking the dividend out there. But if you find specific underlyings that you want to hold for a considerable amount of time, go for it. Who am I to say, hey, if you like Eli Lilly, if you like one of these oil producing firms, buy it, hold it, sell premium against it, and collect the dividend. I am tentative on the pure dividend play. The pure dividend play seems like a risky one after we've seen the S&Ps grind up day after day for the past 3 months. Like I just don't like a lot of stuff at these levels.
Oh, okay. Thank you very much.
All right, Mike, good talking to you.
All right, bye-bye.
So with that, towards the lows of the day, again, my favorite number on the S&Ps for the last couple of weeks has been 1343. We are now at 1341.25. I mentioned that 1343 level because, a few weeks back we were sitting at the level of 1343 and it traded that level every day for like 11 days straight there in the marketplace. Anyway, with that, let's jump to the next caller. And before I do that, if you guys would like to call in, give us a call. 877-927-6648. We we would like to hear from you because ultimately that's what this is. It's the option hour. It's your hour to call in regards to stocks, options, futures, commodities, exciting stuff. We're going to go to Steve up in Michigan's got a question about call spreads. You there, Steve?
Yeah. Hi, Don. Good to talk to you.
Hey, how you doing? Sorry to keep you holding there.
That's all right. Good listening while I'm waiting. So my question has to do with your portfolio enhancement. You talked about that before on swim lessons, so I went back and listened to your old webinar on that. And we started to do that. We actually have a options education club with some of my kids, and we're learning together. So we started the portfolio enhancement, and I understand how to put it on, and we ran the numbers, and my son-in-law made a spreadsheet on it to show all the different scenarios, and we really like the idea of it, so we're doing it. My question is, or our question is, we were talking about this last night, is when to roll that. Now, normally I know you like to say roll 4 to 10 days before expiration, but is that still hold true for something like that where you're just going to write another one anyway in a few days regardless of where the price is?
Yeah, so I'll give you a couple of different caveats on that one, and let me just reference to kind of everybody listening what we're really talking about. Portfolio enhancement is, for the most part, like if you guys happen to be watching the screen show, I've got a portfolio built here of Apple and J.P. Morgan and Coke and the Qs and RIM, and you could have a variety of different underlyings. And ultimately what a portfolio enhancement was is rather than going out and selling a covered call on each unique underlying, we were basketing the portfolio together and ultimately selling, for example, one giant covered call in an ETF that correlated my portfolio. From a transaction standpoint, it works out really well. Instead of selling covered calls in 5 or 10 or even 20 different underlyings, now you're selling one giant covered call, for instance, in the spiders. And I use the spiders because I've got a portfolio of Apple and J.P. Morgan and Coca-Cola and Qs and RIM. So I would go over and I would look in the spiders and I would go out of the money. The option that you sell would be between like a 30 and 40 delta. I've got delta up on my screen right now, so got a 38 delta option that happens to be highlighted, which is the 137 calls. Now, in this example, you can't just go out and sell a call and sell it naked because ultimately you don't own the physical spiders. You own a portfolio that happens to mimic the spider, so we utilize a spread. It's typically a $2 wide spread. In this case, I'd go sell like a 137, maybe 139 spread, about a 74-cent credit, 75-cent credit. Great, done. The spread looks great. You got to figure out, obviously, the number of contracts in here. The question is, when do I close this and or roll it? Well, here's some of the caveats. First, I don't like the idea, Steve, of driving this trade until expiration. And the reason I don't like the idea of driving it to expiration is, first, the short 137 calls, if they're going to fall out of the money, like I get it, you don't want to pay the transaction cost to buy back the 137, 139 spread, and you're going to sell another one anyway. But, case in point, if we do close right around that 137 level, or if those 137 calls are even slightly in the money right around expiration, of course you could be assigned. More importantly, the spiders also pay a dividend, and you could be assigned early because of dividend. But that's neither here nor there. The other aspect is if you don't close this or roll it before the expiration, let's say you just let the option expire worthless, which a lot of people do. You're then waiting to the Monday after expiration Friday, and then, of course, selling more premium. What's happened over the years, there's so many traders selling covered calls that ultimately you'll see that premiums are typically deflated on the Monday after expiration Friday. And people say, well, why? In the end, option pricing is about supply and demand. And, there's a lot of supply on the Monday after expiration because there's so many traders selling calls. Like, when you're a market maker, you stand down there, you can expect on the Monday after expiration that premium sellers are coming in. So you want to buy this thing back a few days before the expiration and roll it. And there's the one other caveat is if the market drops substantially and you can buy back this spread for next to nothing at any time during the expiration cycle, you should probably do it and roll it right then and there. I mean, that's really the only caveat. Like Steve, I don't think much about how to roll my enhancement. To me, it's not a trade. It's an enhancement. To me, it's like something blind I'm doing on the side to try to reap a little bit of statistical benefit due to the time decay. And that's kind of it in a nutshell there.
So in other words, just for example, like you might do that 6 or 7 days before, religiously, regardless of trying to get closer or further from your strike or whatever.
Yeah, I mean
more or less automatic.
I mean, I have tendency. Again, my own trading, I have tendency to try to time it. Where the underlying is definitely has an effect on me. If we drop, big on a Friday before expiration Friday, I may try to roll it right then and there. But more often than not, I find myself panicking on Tuesday of expiration week. It's holy crap, I haven't rolled my my trade yet. So yeah. I tell everybody pretty straightforward. But I got to tell you, being consistent and panicking like that seems to have worked out for me fairly well. In that, every time I've tried to think my way through a trade, the S&Ps are going to do this, or this is going to happen. When you're rolling to the next month and you're going to do it every month anyway, it doesn't matter all that much what day you roll it, as long as you're consistent on how you're rolling it. Meaning that, whether you're 5 days before or 7 days before isn't going to make that much of a difference, because ultimately you're buying back premium for 1 month, just selling it for the next month. So anything that you gave up, for instance, in this expiration cycle, you might get back because you're selling next expiration cycle. It's neither here nor there at that point.
Okay, so what we were talking about was the speed of acceleration of the decay. It seems like in those last several days is where you make all your money, because we were looking at one that we put on as a paper trade, for example, and that one had just made a few dollars.
Right.
And there's not that much time left to expiration. I mean, we're already within the 10 days where you would start to be ready to roll it. We're still, under our strike, yet we're just a little bit above our break even.
And that's absolutely so again, you're kind of focusing on the individual trade a little bit more maybe necessarily than I would. Every single time you have one of these enhancements on, you really hope to lose on the enhancement. I mean, you hope that the underlying is at 140 because you're enhancing the portfolio. So that's all I'm trying to do is just reap a little bit of benefit statistically. Now, once in a while, you will see during an expiration cycle, it doesn't seem like premium drops off until the bitter end. So be it. Time decay doesn't come out really in a linear fashion, meaning we all know that time decay gets exponentially greater coming closer to expiration, but ultimately, time decay, sometimes volatility gets pumped back into the marketplace and then drops off before the expiration. So again, being consistent just helps. Expiration after expiration, being consistent ultimately helps kind of level things out over time. So really, in essence, you got to come up with a specific time frame. I don't like to hold things to Thursday or Friday of expiration week. I don't like it. I'll tell you, in all the trading I've done, there's probably 3 or 4 trades that I did not close before expiration in my career of trading that cost me a lot of money. A lot of money with things blowing up in my face right before an expiration cycle, and it happened specifically in the S&P 500. So it's always been a pretty sore spot with me. A couple of years back, it was in 2008, Ben Bernanke came out on an expiration Friday with 20 minutes to go to the open, and he lowered the Fed discount point by 1 full basis point. I don't know if you remember that. It's before the market really crashed in 2008. And the S&Ps opened up. The spiders opened up $4.50. It was a gap up of $4.50, and I had an option that was $2.30 out of the money that ended up obviously fairly deep in the money. It wasn't a comfortable position. Not real thrilled about that one.
Yeah.
Still, and that's the kind of thing that ultimately catches you off guard. And one of those in your entire trading career costs more than having rolled these positions for years on end.
Yeah.
Anyway, I got to jump to another caller, but
okay.
Thank you for calling in, and feel free to shoot me an email anytime.
Okay, thank you, Don. Bye-bye.
All right, thanks a lot, Steve. So we are going to jump over to our next caller. But again, we've got plenty of time, plenty of callers on here. You guys should give us a call, 877-927-6648. Let's see if I can not butcher this next name. Is it Nabil? So,
Yeah, that's
Nabil,
correct.
Did I get it right? All right. I didn't want to get that wrong. You're over in Atlanta, and you got a question about the SPX. What do you got for us?
Well, here's what I did, and it's a two-part question in a sense. So I was long on some different stocks in my portfolio, and what I did, I bought a put SPX, but far out in the future, like it was June 2013, just to protect my portfolio in a sense.
Sure.
So the long did very well. So I sold out of the longs last week, but I'm in losing position on the put, the SPX basically.
Right.
At this juncture, I mean I can just sell it and take a loss on it, but can I do something else with it, like sell put and turn it into a spread? That's my first question. And the second question, if you were me, how would you done it? Would you pick still like a June? I picked June 2013 actually. So will you pick something closer in time, or how will you done it basically?
So I'll give you a couple of different scenarios in here, because I've actually had, I don't know, I've had a lot of times where I've thought about like going out and maybe buying puts for some type of degree of protection against a portfolio, and that's ultimately what you initially had done, correct?
Yes, that's correct.
But I find that the puts, even in a market that has extremely low volatility, or what is perceived to be low volatility, like right now, the puts are still extremely expensive. So my question is, how much of a hedge does buying puts really provide? And the answer is not that much, because the puts themselves, not only are they expensive, but the second aspect of buying puts is they're further out of the money. So you're buying some out-of-the-money puts. They're a little bit expensive. So my question is, if you calculate exactly what kind of a hedge those puts give you, you may only start, to mitigate your risk 15 or even 20% out of the money, meaning that if the markets were to crash 15%, you might not get any protection for the first 15, even 20% sometimes, after you factored in all the cost of those puts. So with a client that, I was looking at for an individual portfolio, how much protection does that provide? Because couldn't you just say, all right, the market sold off 10% today, I'm out, or I'm going to lighten my position by half, and that could give you as good of a hedge as having gone out and bought puts. Now, again, I'm like, an option trader, but at the same time, there's times where I don't necessarily like to buy premium. Premium is expensive, and out-of-the-money puts in the SPX are extremely expensive because there's what they term skew. There's so many traders buying puts right now, and ultimately, to finance those puts, they're selling calls. So in effect, what you get is more expensive out-of-the-money puts, and you're getting out-of-the-money calls that are trading relatively cheap to the implied volatility. Anyway, that's, I guess, a little bit in regards to having bought puts in the first place. The other aspect is, so right now you're sitting in a position, when you buy puts, you're buying them as a hedge, and you kind of have to almost hope to lose that money. If you do buy them, you have to kind of hope to lose the money, because if you're making money off those puts, they're not going to help you. If you try to wiggle out of this trade or fix it in one way, shape, or form, you're probably just going to cause yourself a bit more risk at this point. More risk, more transaction costs. Today, you've had a pretty nice push to the downside in the S&P 500. A day like today could help you get out of these puts for a little bit less of a loss. Now, granted, we've run up here considerably, and I don't know how long you've owned these puts. But a day like today, ideally, you're going to want to get out of these things if you do sell out of the puts on a day the market's down and the volatility is up, which we happen to have today. But, that's right now. We'll see in a couple hours if markets try to rally up or not.
Okay,
So, I wish I could tell you that buying puts is phenomenal. Buying them further out in time, like you did, it is viable. But again, I think as a retail client, your positions are small enough and you can be nimble enough to get out of trades, or, when the market's topping out and if you feel like a little nervous, it's okay to sell a portion of your position. Because if you sell a portion of your position, it's lightening your delta risk, it's lightening your directional risk, and ultimately it's the same thing, all right, as buying puts. Well, risk mitigation from selling part of your portfolio and risk mitigation by buying puts really can be construed as one and the same thing.
Okay. Yeah, absolutely. It makes sense.
Yeah. So I figured I'd give you the odds and ends of it. I've never been a huge advocate of it, of buying puts out there. And I work with a lot of retail clients, but I do a lot of work with TD Ameritrade institutional clientele. That is, they're money managers, and they have 50, 100, sometimes $1 billion under management. They're a different story. They're not nimble. When you have $100 million in a portfolio, you can't start whacking out of the portfolio in 10 minutes. But as a client, no matter how much money you have in your account, you could have $20 million. You could lighten the load immediately, with a click of a mouse, and in a few moments have half the risk on the table, which I think makes you more effective than portfolio managers that are forced to go out there and buy those puts.
Absolutely, yeah, absolutely makes sense.
So, Nabil, thank you very much for calling in, and give us a call in the future.
Thank you, Don.
All right, thank you. So with that, some phenomenal questions today. Quick market update for those of you listening, and then I'm going to jump to another caller. By the way, if you want to call us, it's 877-927-6648. And, you guys should know the number right now. I know the number, and I haven't even been on the Option Hour on TFNN in quite a long time. But, hey, I wake up in the middle of the night screaming at the top of my lungs, the number out there. It's just, it's ingrained in me. Anyway, with that, S&Ps now are down 2150. The VIX is starting to pick up a little steam, if you had not noticed. It's up 275 right now. Again, towards the higher end of the range. Anyway, with that, we're going to jump to Mark in L.A. He's got a question about XLE diagonals. Mark, you there?
Hey, Tom. Yes,
hey,
I'm here. How you doing?
Yeah,
I heard
go
you
ahead.
at your other venue, so I popped on over here to see if I could call in to you real quick. I'm kind of new to multi-months. I've done calendars of bad stocks like RAM and stuff that didn't really work out. I did a diagonal, though, one lot, not big. XLE. I did I bought the quarterly 75 and I sold the March 74. It's coming in, but my question is, what's the philosophy here? Do I get out as a package, take a profit, or do I roll that 74 to quarterly 74 for about a 50-cent credit? Which isn't bad, but I actually got in at this diagonal for a 6-cent credit.
All right, so let me just kind of reiterate here. You've got the March against the March quarterlies?
Yes, the 75 quarterly and the 74 I sold. XLE is about 72.65 now. It's about a 18-cent winner right now. But
So what's interesting about this is when you've got a position on like you do, I mean, ultimately you've got again, we call it a diagonal, but in essence what it really is it's a calendar spread with an embedded short spread component to it, and that calendar spread is right, as we come closer to the March expiration, which we're coming into the last 10 days, it's screaming to you, all right, as the trade starts to mature, roll it or get out. In the next 10 days, you've got to make that decision. Well, ultimately, the price of the underlying, if it facilitates you and the spread widens out, if the diagonal widens out, you might just want to bail out of it, because the question I have for you is, when you're in a 74-75 diagonal, the risk parameters are such that ultimately the sweetest spot for you to be in a 74-75 March quarterly diagonal in the XLE, the sweetest spot we could be at. 74 on the button, pretty much.
Yeah.
Right? So if the 74s basically, blow out, expire worthless, and the 75s are pretty close to the money, it's going to work out nicely for you. Okay?
Right.
But if you roll this from the 74s in the March to the 74s in the March quarterly, now it makes you short the XLE. And I'm not opposed to rolling it at all, but I need to know, do you want to be short,
the
XLE? And that's your own
credit, basically what we're talking about.
Right. You're just going to be in a credit spread after that, and you've got to decide. Like, there's a lot of times where I have to tell you, I thought I was getting cute, and I've like rolled these spreads before, and I said, oh yeah, so I rolled my diagonal into a vertical, and then I'm like, wait a second, did I even want to be short this underlying? You know,
right.
So I have a tendency to worry less about the morphing of the trade and more about what the roll value is worth. And hey, if you want to be short the XLE, beautiful. You know, bail out of it. If you think, you know, you're going to come in right around that 74, which I got to tell you, we're pretty close right now. It's 72, you know, and 87, $73 basically. You're getting close, and you're in that 10-day window. You really got to start to think about, executing this thing.
Yeah, I may bail just to get the. Cause again, I'm not a real expert at multi-month. I've been doing a lot of verticals. I'm kind of selling verticals. I'm familiar with that. But, okay.
Yeah.
Curious.
Yeah, I'll tell you, that's it's a decent trade. Thanks a lot for calling in, Mark.
All right, I'll see if I can see you guys April. I understand you're going to be the JW.
April. Oh, are you regards to in Phoenix?
Yeah, TD Ameritrade thing you got going on there. But yeah, my wife's been at the JW a long time ago. It's a real nice place.
Oh, nice. No, I thought you were in L.A. They had posted L.A. on here. Oh, you're in L.A., but you're going to come to Phoenix to see us. Wow.
Get out there occasionally. All right. Anyway, thanks for your help.
All right. Thank you very much, Mark, for calling in. By the way, as Mark was just mentioning, I was mentioning it in Tampa a little earlier. So myself, Tom Sosnoff, we have tendency to run around the country still to this day and do kind of a TD Ameritrade presentation. It's a day in regards to options, some of the ThinkorSwim technology out there, and ultimately, Tom, kind of later in the evening, people continually ask me, hey, so what's Tom going to discuss in the evening? And the answer to it is not even Tom knows. He has no clue, and he'll figure it out a few minutes before with me in a panic. No, just kidding. He's definitely not panicking about it, but the reality is he really doesn't know what he's going to talk about. We figure out what's going on in the market that particular day. It's always an interesting conversation. But you guys, if you're ever interested, you can always fire us an email at events@thinkorswim.com. It's events@thinkorswim.com. I know we're going to, I'm just thinking off the top of my head, we're going to be in Tampa, we're going to be in Phoenix. I think we're actually going to be in New York as well. We're heading back to New York in May. I think it's like May 5th. We're going to be in New York, so those are always kind of fun events. It's the, I don't get to travel with Tom all that much anymore. So with that, back into the option hour. Lines right now are wide open. We don't have any callers waiting, so if you were thinking about calling, waiting, just give us a call, because the number is, of course, 877-927-6648. Again, what are we seeing in markets today? Well, for the first time in a very long time, we are seeing selling. Oh, how very, very nice. Again, I think this is, I think we all agree, selling has been kind of long overdue. Need I bring up something like Home Depot? I've got to bring up this underlying because I'm not much of a market technician over here, but this chart is just completely out of control from its lows here in October at $31 up to $46. You really have to start to question this. Home Depot, though, is starting to break to the downside. I just think that's pretty indicative of the rally. I saw turned on this morning, CNBC. Yeah, I watched CNBC early this morning, and they were discussing how the NASDAQ was up, 13% and change year to date. Now, the irony of that was before the market opened, but 13% year to date. And you just think about, are we going to kind of continue on that level? Well, that would not be a possibility, or the NASDAQ would be up over 100% in a short amount of time. What do you think this is? 2000, 1999? I don't think so. Anyway, with that, I'm going to jump over to another caller. And again, you guys can give us a call anytime you would like here. Well, we've only got about another 10 minutes left, so 877-927-6648. I'm going to jump to Matt in San Mateo, California. You there, Matt?
Yeah, I'm here. Hello. How are you?
Good. How's it going?
Pretty good, thanks. I wanted to ask you about Caterpillar.
Yeah, go ahead.
What I have is a straddle on that. I bought it about a week back when it was sort of flatlining at around $115, $116. It was at the money straddle at the time.
Yeah.
And it just
was that
seemed
in March?
Like this is in April, actually.
Okay.
Yeah. So it's doing fine now. I'm just wondering, what is a good way, now that we've had sort of a move to the downside, what is a good way to work out of those things? It's
all right,
the first time, I should say, that I bought a straddle. I generally don't like them, but it seemed like a good opportunity.
Yeah, you know what? I'm not a huge premium buyer. I think everybody that's kind of heard me before on either TFNN here or on ThinkorSwim, I'm definitely not a huge premium buyer. So I can't say like, I go out and buy a ton of straddles. But I can tell you this. Your timing would have been really good in Caterpillar. I mean, just to look at this, at the $115, $116 level, assuming that you bought the 115 straddle over there, I mean, again, timing is good. The question is, even with timing, are you ultimately profitable? And the answer should be, well, the 105 straddle, the at-the-money straddle now, is still trading for, looks about like $9 and change over here. So it's still pretty expensive. The 115 straddle is going for right now in the neighborhood of close to $12. So, you're profitable, yeah, but you're not hugely profitable in here. Well, one of two scenarios I would look at for exiting here. If it's very small contract size, ultimately if you're profitable, you can just blow out of the trade and say, all right, chalk it up to picked a good time to get into the straddle, picked a great time to get out of the straddle, because one of the difficult things is if Caterpillar obviously retraces back up to that 110 level, it's going to hurt. It's definitely going to hurt. The other scenario that you could consider is that there's not a whole lot of premium left in those calls. They're still trading the 115 calls, or for April, they're trading for about $1.
That's right, yeah.
The 115 puts are trading for, in the neighborhood of a 1060, 1065. You could scalp out of some of the puts, and ultimately what that does is it lessens some of the risk ultimately of the trade. So if you have 10 contracts on, you could scalp out, for example, of 5 contracts of the 115 puts. The calls you could ultimately leave alone, but you could scalp out of 5 contracts. That would leave you then, if you had a 10-contract 115 straddle, that would leave you left with, you initially bought 10 contracts of the calls, you would have bought 10 contracts of the puts. It would leave you with 5 contracts of the 115 puts, 10 contracts of the 115 calls. What that in essence does is it, number one, still leaves you some downside potential, but number two, if the market starts to rally back up, the calls will once again expand in price. That's actually a form of what they term gamma scalping. I'm just scalping off a couple of contracts here, a couple of contracts there, in essence, to do that.
Okay.
So, there's not, not too much else you can do, and just the volatility getting pumped up today, especially in Caterpillar. Volatility is also up in Caterpillar here with it down, $4 or $5 in the day. It's helping you. It's definitely helping you on this straddle.
Yeah, I mean, the Caterpillar volatility was just extraordinarily low, a week ago.
It is. I'll tell you, I'm surprised because I've been tracking, I'm on daily here, and I've been tracking Caterpillar for a while, only because one of my coworkers, Jeff Bierman, he's constantly talking about Caterpillar. So I've been looking at the implied volatility. It's up right now a decent amount versus where it was just a few weeks ago. So, it could have just as easily, the volatility could have, stagnated or even gone down at that point. But this has been a decent trade for you. So I'm not this huge advocate of premium buying, but at the same time, I would say that, man, you picked the right time to buy some premium.
Yeah, I was listening to your show the last few weeks, and it seemed like the tenor was, look at the volatility. It's extraordinarily low, and it was. That's why I did it. I don't, like I said, this is the first time for me too. Can I ask you one other question?
Fire away.
Really quick. On this subject, what do you, when you're trying to evaluate buying volatility, do you look at implied volatility relative to historic closing volatility or implied volatility relative to where implied volatility was yesterday or a week ago or a month ago? How do you evaluate what is cheap when it,
So more often than not, okay, I'm a big index, specifically index ETF, kind of a trader. So Caterpillar might not necessarily be in my, in my wheelhouse, but, when I look at implied volatility, more often than not, I reference the VIX. I reference the VIX a lot. And I'll look at the VIXs, because it's the vol of, for instance, the spiders out there. So I don't look at historical volatility. Okay, I don't look at it for my trading because that's the, the standard deviation of the past stock price movement. To me, I'm constructing option strategies, so regardless of what I think the stock is moving or how fast the stock is moving is not that imperative. I'll look back, and I'll always have like a running, kind of tab in my head of where implied volatility was in previous weeks and previous months in the S&P 500. Now, if you're trading something like Caterpillar, you just get comfortable with where the implied volatility was with that specific underlying. And the implied volatility that I typically reference is I'll just look over like on ThinkorSwim on the right-hand side of the screen, and I'll look, at, 2 or 3 expiration cycles and ultimately get an idea of where implied volatility is. So, again, I'm much more comfortable looking at what's ultimately pricing the options at this moment in time. And if you don't remember or, you need to revert back, you just go over to the Analyze tab in ThinkorSwim and utilize Think Back. Just go back in time and take a look where the implied vol was a few weeks ago. I think that'll provide you a little bit of clarity there.
Got it. All right. Well, Thanks very much for your help.
Good deal. Thank you very much for giving me a call there, Matt.
All right. Have a good one.
All right. You too. So with that, some phenomenal calls here that have come in today on the option hour. We've got a few minutes left, so if you've got the means, give us a call, 877-927-6648. We've got just about 5 minutes left to take another caller here on the show. Anyway, with that, kind of just a quick discussion about a couple aspects of the market and so forth. Obviously, we're seeing some selling today, as I was discussing there before I took that last caller. Was, ultimately this is the first real day of selling we've seen in the entire year. For those of you that trade a little bit more actively, most of the active traders have tendency to be typically on the wrong side of the market. Most of the more active traders happen to be a bit of contrarians. I am definitely kind of what I would term the quintessential contrarian out there, and that doesn't necessarily mean getting bearish every time the rest of the world is bullish. I mean, to me, being a contrarian is, here, I'll pull up an S&P 500 chart. It's looking at something like the S&P 500 that has done nothing but grind upwards and since ultimately the beginning of the year. So as we started to grind higher, my contrarian viewpoint said, all right, and that I really thought that the top of this would have been more like the 1340 level. Ironically, we're very close again to the 1340 level. That 1343 has been really kind of this inflection point in the marketplace, and it was an area previously of resistance here. We're going to see today if we hold right in that neighborhood of the 1343 level. Anyway, so to take these contrarian positions, there's a couple different things you can do. Again, I'm here to talk a little bit about options. You can utilize variety of option strategies. You can go out and you can sell out of the money option premium, something like the spiders. But as our last caller referenced, volatility has and was extremely low in the S&P 500. I mean, not many of us really felt the VIX, which was, sitting at the 17 level, was probably going to go significantly lower, though it could. But the VIX, being at 20 and change right now. So one of the things that you should always think about is, how do you take volatility positions? Well, in essence, when I look at a marketplace and I think that we're overdone, I might look, if I feel the market's going to sell off, I'll look at a couple of different factors. Number one, how do I position myself for the market selling off? And ultimately, number two, how do I position myself if you feel the markets are going to sell off, specifically the S&P 500, how do you position yourself to be net long volatility? Well, the answer happens to come in a version of calendar spreads. Calendar spreads make traders ultimately long volatility, and short the marketplace at the same time. But the calendar spread also has some drawbacks. What are the drawbacks? You have to be right. I mean, for example, if I come out here and, pulled up like an April-May calendar spread, in essence, on, on the platform, and I picked it at the 129 strike that is selling the Aprils, buying the Mays, the 129 strike over there. Okay, ultimately, I'm going to need the spiders pushed down towards the 129 level. So in essence, what I have tendency to discuss is more not necessarily one trade, but creating a position and ultimately scattering several calendar spreads. And as volatility expands, so do your calendar spreads. And ultimately, by sprinkling a few calendar spreads out of the money, okay, in essence, on something like the spiders or the IWM, I'm in effect, okay, not giving myself one area of profitability, but kind of spreading out the profit window there just a little bit more considerably. And these are all, again, ideas for you guys to kind of create what could be considered a bearish trade. Now, on a day like today where the volatility is up, $2.68, it's tough to construct, long volatility trades on a day that volatility is already up. Anyway, with that, S&Ps here down 22, NASDAQ futures down 31, the Dow futures down 210. It's a fun day today. The VIX up 268, and the bonds obviously rallying today. Looks like an ugly day out there, folks. For those of you that are bearish, hey, hope it continues. For those of you that are bullish, I'm sorry. We're allowed, us bears are allowed one down day in what seems to be seemingly unstoppable upside market. Anyway, on behalf of TD Ameritrade, ThinkorSwim, myself, and Victor Jones, who typically does the option hour, I want to thank everybody also over at TNN for having me on today here. Kind of put me in as a pinch hitter here last minute, but thank you guys very much, and we will be back next week for the option hour. Thanks a lot, everybody, and have a great day. Bye-bye.